Okay, good evening, and thank you for joining us. Tonight's webinar is What the Heck is Cost Segregation? Our special guests are Bill Smith and Steve Schuessler from ELB Consulting, and they'll walk us through this incredible real estate tax benefit. ELB Consulting has completed over 14,000 cost segregation studies over the past 20 years, and they have never had their study rejected or denied by the IRS. So I'm excited to have Bill and Steve share. President of Break of Day Capital. Our other host is Kyle Mitchell, Managing Partner of Limitless Estates. Our companies work together and focus on acquiring multifamily real estate investments that offer value-added opportunities. We look in growing markets for undermanaged assets to maximize investor returns. I've personally invested and syndicated in over 1,500 units. I run meetups in LA and Phoenix. I know a bunch of you that are on tonight's webinar have attended, and if you haven't, we'd love for you to join us in the future. I've been a successful entrepreneur my whole life. I've started a nonprofit and eventually found my way to multifamily. I most recently was on the Best Ever Real Estate Investing Advice podcast, so I welcome you guys to check it out. Kyle is the lead sponsor on our 42 unit in Tucson. He has 15 years of experience in operations, management, and logistics, which is so critical when you're managing these properties. And I think that's what really separates us from a lot of other sponsors. Kyle's a co-host of the weekly real estate podcast, Passive Income Through Multifamily Real Estate. If you haven't listened to it yet, definitely check it out and subscribe, as he always has great guests and a ton of valuable content. He's the leader and host of multiple meetups for multifamilymasters.com and is a student of Michael Blanc. Be sure to sign up for next month's webinar, Multifamily Real Estate Investing 101, where we'll show you what every passive investor should know before investing in multifamily real estate. That takes place on Monday, November 18th at 6 p.m. Pacific. Without further ado, let's jump into what the heck is cost segregation with our special guests, Bill and Steve from ELB Consulting. Bill, why don't you tell us a little bit about yourself and ELB?
All right, Gary, thank you so much. And thank you for having us on this great podcast here to talk about cost segregation and really to break it down in a simple manner. My name is Bill Smith. I'm the Director of Business Development. I reside in Raleigh, North Carolina, and have been with ELB for since 2013. Was in the real estate finance industry for over 20 years before I found these guys. And Steve, he can introduce himself, but he's been in this business for a number of years, and he's the tax expert and a master's of taxation. Steve, you want to give a quick background?
Yeah, thanks, Bill. You're right. I do have I've got a master's degree in tax from Golden Gate University in San Francisco. So my background really is more from a tax perspective. We also have people on staff that are engineers and quite a bit more construction oriented. So it's a very unique mix between the construction and the tax. And we, as a company have formed a very unique kind of boutique firm with all those bases covered. I've been doing cost segregation since about 2002. So I've been at it for quite a while, and I've seen a lot of changes. And right now, I think we're in a great period for cost segregation with the tax structure the way it currently is situated.
All right, excellent. Well, I'm going to go ahead and jump in, and the goal is what the heck is cost segregation? And we want to make it simple. We're not here to talk a lot about ELB Consulting. We will touch a couple things in there, but our goal is to kind of tell you kind of what cost segregation is, how it works, and how it can benefit you. We always, like any presentation, there's legal disclaimers. We're not giving tax advice. We're not CPAs. We're talking about how this works. And of course, every situation is different. Your structure, your corporate entity, how the taxes are impacted. But at the bottom, at the core is really how this works. And so what we're going to talk about, kind of the core components of cost segregation and depreciation deductions. So the first thing we ask is, do you have rental properties? Whether it's a single family, rental, it's a 2 to 4 apartments. A lot of people do the starter kits before they get into multifamily and get into 10, 20, 30, 50, 100 unit things. So do your properties create a tax liability? So if you're creating income and have tax liability, then yeah, cost seg is going to work for you. would you like a method to, reduce that tax liability? Again, cost seg is an answer for you there. And of course, a lot of you folks, and Kyle, I know your project is a value add improvement project, which really, when you go into value adds, whether it's a single family or a multifamily project, cost segregation really brings a lot of benefits. We're going to get more into that as we go further. So the definition of cost segregation there on the right side of the screen, it's the review and identification of your fixed assets, commercial real estate and income property, as with the MACRS, which is Modified Accounting Cost Recovery System. If you heard the term MACRS, that's what that means. I usually think bourbon when I hear MACRS, but that's the physical definition. But essentially what we really do is we optimize a depreciation schedule to improve your cash flow and reduce your tax liability. So, and how do we do that? It's really looking at the time value of money, taking those deductions that would normally be spread over 27.5 years and pushing a lot of those forward. That's where the time value of money comes into play. So what cost segregation does is a complete component breakdown of your building parts and pieces. So, different components, your flooring, your dryer vents, different things within the units have a different life, have a shorter life, which brings deductions forward. As you know from your personal taxes, more deductions means you pay less taxes, you keep more of your money, and you can reinvest it in more property. So a couple key things: you've got to be a for-profit entity. If you're a nonprofit, cost seg is not going to do you any good. And you have to have a tax liability. If you've got carry forward losses, or you don't need additional tax losses or deductions, it's not going to help you. And it really focuses, now you guys are passive income investors, so it's really focused on passive income. If you were a real estate professional and you're an active participant, it can offset your spouse's W-2 income or any other types of income. But today we're really focused on the passive income aspect. So people think, well, it's a loophole, something's going on, Washington's crazy, they're going to change tax law. So cost segregation is not a loophole. It's an IRS guideline and has been since 2004 when the IRS finally defined it in their guideline books. It had been utilized since 1986 when the tax law changed back then. But you can see the IRS, the Wall Street Journal, Department of Treasury, Journal of Accountancy, all have quotes promoting the benefits of cost segregation. And essentially, the IRS would probably prefer to see you, segregate your components and do accelerated depreciation as a proper method than just the straight line depreciation of 27.5 years on a residential property. So how does it work? How does it give the owner benefits? So cost segregation, in short, it's a tax planning strategy to increase your cash flow and reduce your tax liability. So it can really, you look at a commercial building, doesn't matter whether it's brand new, you just built it, that's existing, a historical property, you just depreciate it faster, which increases your deductions. And one of the things a lot of people and CPAs tend to overlook, not because they don't understand the taxes, they just don't deal with cost segregation that often. They understand it, but many CPAs aren't very familiar with it because they don't work with real estate a lot. But you can reclaim missed depreciation. So if you purchased a property 5-6 years ago and you didn't know about this, or you didn't have a need at that time, we can do a look back study and reclaim that missed depreciation. So it kind of looks back, catches up, reconciles the straight line depreciation you've taken for 5 years, and then brings all your accelerated depreciation to current day's value with a lump sum of deductions. So,
hey Bill, and if I can add, with that look back study, there is no amended returns required. You can just do a change in method of accounting, which is an automatic approval, and so it's a very, very seamless process to go ahead and do that look back study. And again, there's no amended returns required.
Right, that's the thing I want to point. A lot of the CPAs think, oh, you've got to amend returns, but no, you don't. You can just kind of catch it forward. And again, with a Form 3115, a technical IRS form, change of accounting method, you just basically change your accounting method. Another thing you guys have heard about, Tax Cuts Jobs Act and 100% bonus depreciation. What the heck is that? Well, we have a slide for that. But because of that, this is just so much better than it's ever been, cost segregation. So let's talk about kind of how it works. Together, some of these things we're talking about. I just got my internet connections unstable. I hope you guys can hear me. Steve, can you hear me?
Yeah, you're still good.
Okay, good. Sometimes my screen pops up. So, I like to call it treasure hunting. So significant savings are hidden in your property. So the 5-year property, what happens, we break these components down. 27.5 year is your straight line depreciation for residential property. It's 39 years for commercial. But what we look for is 7, 5 and 15-year components. The 5-year components being cable TV rough-ins, flooring, decorative lighting. I put some things basically in here that really are in your apartments. Millwork, built-ins, appliance hookups, dryer vents, those kind of things in the property are your 5-year. So they're going to get short life to a 5-year depreciation schedule. 15-year is pretty much your outside land improvements. Your property, your land itself doesn't depreciate, but in value. But the sidewalks and paving and curbing and fencing and tennis courts and tot lots and all those kind of things, those become a 15-year depreciation schedule. So again, by bringing these forward, you can improve your deductions. And the Tax Cuts Jobs Act with 100% bonus, I've got in a slide later, looks at all those short life components. So what happens is these accelerated deductions really look at the time value of money. You take them now. What people like to say is, if you won the lottery, do you take the 20-year payout or you take the cash up front? People take the cash up front. And what I'd like to say, I think I got this from you, Steve, cost segregation is essentially an interest-free loan from the IRS. I think that is nice way to put that for those guys. So for you scientific types, how do we break down a property? Because breaking it down is very important, using the IRS guidelines, understanding what happens. So for all you guys that like biology, I broke this down, your skeletal system, that's your core structure. That's your 27.5 year external improvements, our internal property, wall structure, systems, roofs. You've got your muscular system, your millwork, flooring, cabinets, ceiling fans, etc. Vascular system would be your general electrical and plumbing system. So there's general electric and general plumbing, which you need. You need plumbing for the toilets and the kitchen sink and the core plumbing, but specialty plumbing for washing machines and other different kind of components and swimming pools, that's specialty plumbing. And those are the short life. You have to have general function just for your building, but it's the specialty components that short life. Specialty electrical, the supporting power control systems, things like that, your phone line hookups, and then specialty mechanical and plumbing is your vital organ. So I like to do a breakdown for the science people just of how we actually break down a property into its component parts. This one's a little more familiar to people who didn't like biology class. I wasn't really good in biology myself, but we've got everybody recognizes the Big Mac, right? So you've got straight line method of depreciation. If you look at a Big Mac, what do you see? You see a hamburger, a plain, boring hamburger. It's one thing, not components. It's 39 or 27.5 years, period, real property. So that's what you look at when you look at straight line, when you look at a Big Mac. However, if you were to cost segregation, everybody knows the song, to all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun. It breaks it down into the parts and pieces. So you can look at those structural and non-structural components to find out what short lives and what doesn't. And that's what's key, is how someone goes into the property and breaks those components down. So the keys are 5, 7, 15 years that we look at primarily in residential property. So hopefully that kind of brings it a little more together as to what the heck is cost segregation. So what is bonus depreciation? Everybody's heard about bonus depreciation. You know what that is, maybe. You think, oh, we get like a double bonus, it's like a twofer. Not quite. So the Tax Cuts Jobs Act implemented bonus depreciation, which means 100% of the depreciation can be taken in year 1. So what that means is anything that's under 20 years, so all your 5, 7, and 15-year property, all those deductions, instead of spreading them over those particular years, short-lifing them, it can all be pushed up in year one. So that gives you huge deductions in year one, and you don't lose them. It carries forward. It's all your depreciation. If it was a $10 million property and you had 35% depreciation, you'd basically have $3.5 million in deductions in year one. If you couldn't use those or pass them through to other, passive losses, then, it just carries forward with this particular property. So the other thing the IRS did with the Tax Cuts and Jobs Act, which is what really changes this, they've had 100% depreciation in the past, is to add what they call used property or acquired property to bonus depreciation. Previously, bonus depreciation only applied to acquisitions, new construction or improvements, and not acquisitions. So they added acquisitions or used property. So that's really how it's made it better. And they've had it at 50% for a number of years. They've switched it off. It was 100%. I think in 2003, Steve, was that when?
I believe that's correct, Bill.
So again, you just push it all forward. You take it all year one. You don't lose it. It carries forward, and it's actually an option. You don't have to take 100% bonus depreciation. You can take it's an election that your CPA will do. If a company like ELB does your cost segregation report, we're going to give you all the breakdown by year, by component, all the asset detail. When your CPA inputs your taxes, then they'll elect 100% bonus depreciation. So if you don't need that right now, and I've got a few clients that have elected not to take it, you don't have to take it. You're still going to get the accelerated depreciation. You're still going to get great benefit over the first 5 years, years 1, 2, 3, 4, and 5, and then a smaller amount through 6 through 15. But the benefit is you have that option. But again, you never lose it. If you have an excess amount from year one, it carries forward for as long as you have that property.
And Bill, I might add, you truly never lose it, because if you actually get to the point where you're going to sell the building or, do 1031 exchange or something where you're going to relinquish that property, you can take the remaining depreciation at the time of the sale. So you're exactly right. You truly never do lose that accelerated depreciation or the deductions created by the cost seg study.
That's right. You could take those deductions at the sale, or you may not take them, because that would get into something we're going to talk about later, recapture rate we're going to talk about.
Right.
So, it could keep that at a lower amount. So you again, it gives you options. The flexibility with this is terrific. So I want to do a quick example, a $2.75 million apartment. So let's just take a $2.75 million. I just do simple math, 27 and a half years. That's $100,000 in straight line depreciation per year. You can see the first thing is cost segregation without cost segregation. So if you're in 37% tax bracket, everybody's LLCs, high tax bracket, high earners, 100,000 times 37%, it's $37,000 a year in cash value that straight line depreciation gives you. And that's good. That's nothing to complain about. In 5 years, it's $185,000. However, with cost segregation, if 35% of the building qualifies as short life property through cost segregation, you're looking at 27.5 or 2.75 million times 35% to accelerate, 962,500 is your depreciation. That's your deduction that's going to be pushed forward. 37% tax bracket, you take that, you multiply it by 0.37, it's 365,000 net cash benefit. Net cash benefit that you're not paying the IRS pretty much through year 5. It can all happen in year 1, but it just will carry forward. So you're going to look at $365,000 that you're not paying the IRS pretty much through years 1 through 5. Where here you're looking at $185,000. So that's a benefit of $180,000 in cash value over straight line depreciation. So if you had $180,000 in year 1 or years 1 through 5, what would you do? You'd invest in more real estate. You'd get more projects. You'd do another syndication. Whatever that your project is, wherever you want to invest, this is where you could then take this money and use that.
And Bill, let me add something with that as well. So on a $2.75 million deal, we may only raise $1 million. And so it might be a dollar for dollar bonus depreciation and cost seg for our passive investors, which is fantastic.
Absolutely. That's absolutely right. That's a great point.
And if I'm not mistaken, so it doesn't matter when I can close on a property December 28th in 2019. and they'll still get the full cost segregation, bonus appreciation when we do the K1s for 2019. So it doesn't matter, you know, if we close January 1st or December 28th, they still get the same amount, correct?
For 2019, Steve?
Yes, yes, that is correct. You would qualify that for the entire tax year. In fact, to carry it one step further, if you acquire a property anytime mid-year, and if you're making quarterly payments, you can take it on those quarterly payments right when you do the cost seg study. So it's an immediate benefit, or it's a benefit for the entire tax year. That's correct.
Oh, that's fantastic.
Yeah,
Yeah, it really,
that's a great point on just the quarterly tax. Sorry to interrupt, Gary. Is when people do this, they say, well, when's this cash flow strategy happen? And it happens, you know, you might do it earlier in the year and not like on April 15th or March 15th, whenever you're doing your taxes, or if you're extending. Whenever you do it and you assign that form 3115, or you just do this, you can then adjust your quarterly payments, your quarterly taxes accordingly by this. So that's where the cash flow comes from. You have more cash per quarter to work with. So Gary, you were going to say something as I jumped in.
No, I mean, that's fantastic for particularly a lot of our passive investors listening to this. You know, I invested in a deal that we closed last year, end of December, and yeah, I got a $61,000 loss on a $100,000 investment, and you know, as a qualified real estate professional, I mean, it was, you know, that saved me like 22,000, so it was fantastic. And I know.
I lost you there for a second. I know it was fading out earlier. Hope you can still hear me.
Yeah, I hear you.
There you go.
We're good. We're good. Let's go to the next slide.
You're right. Yeah. So no, that's great. So, you know, a lot of people, you know, you're making, you know, the good thing is you've got cash flow, the project's making money, people are getting their payments, but they're not having to pay taxes. So you're able to give your dividends out, your quarterly payments to your investors, but there's no tax liability to them. So that, you know, that's a nice bonus. So I want to talk about the process and how it works if you got involved in that, just real simply. You know, you sign an agreement with the firm, you know, preferably ELB, but there's a lot of firms out there to do this. Then, you know, we've got to collect data and do pre-engineering. If it's an acquisition, essentially we need your closing statement, your appraisal, site survey, and if you've got an improvement plan. And that's it. ELB does heavy lifting. A lot of folks are looking for receipts on everything, but our methodology, we model the building, we price everything out, equal treatment. So we don't really need that. New construction plans and specs and construction cost. Then there's an inspection, and there's engineering and quality control. So depending on if it's an acquisition, we inspect first, we count, we measure, we look at everything in the property, we break it all down from the roof to the trusses to the walls, windows, doors, every component, every outlet, every door, everything. We count all that, and then we go back and do our engineering and complete the final report to deliver to our client. It's new construction, we have plans and specs. We can do all our engineering before we get on site because we've got every single detail, cost that out, and then go out and document. So the inspection should not just be a picture taking event, which some folks wind up doing. We count and measure and look at everything and validate to, again, comply with IRS guidelines. Get your final engineering, quality control, and you deliver the results. So that's kind of how the process works. It's pretty much the same for most people. So real estate professional, Gary mentioned that. I don't know, some of the folks on here might be that, or might be working towards real estate professional, or an active participant. Basically, this means that you got to spend 750 hours of services in the trade or business for your real estate. You know, just because you're a real estate broker or have your license and you kind of do it part-time doesn't necessarily mean you're going to spend those hours. You kind of got to document that and validate it, but it incorporates development, redevelopment, construction, reconstruction, acquires, converts, rents, leases, managements, operations, brokers here. So a lot of the things that you do when you're evaluating properties qualifies. It's like you're doing it at night at home, working up deals, doing spreadsheets and which deals are going to work. These things qualify you as a real estate professional or an active participant.
Now on that, I do want to add, Bill, that if you have a full-time W-2 job, you cannot qualify as a real estate professional. However, if you're married, you could have your spouse possibly get that real estate professional designation, which would help. So you could have one real estate professional and one full-time W-2, which is, I know some of our investors are doing that right now so they can take full advantage of the real estate professional designation.
Exactly. And that, we've got some folks doing that. I've got some clients doing that. Some of my spouse is getting that. We're working towards that. As they're doing the report now, I don't know if I can use it this year, but next year it's going to be golden for me. So yes, that's a great point. Thank you for clearing that up. And so depreciation impact, how does it really work? I mean, there's just I just do simple calculation. Sometimes it's kind of esoteric in here, but let's just talk about a $2 million property, $2 million example at a 10% rate. That's a couple $100,000. In the same year, the owner had $150,000 in units. So you've got a $200,000 loss from depreciation in that particular year, right? 10% depreciation rate. 150,000 in income for tax purposes. That's a 50,000 carry forward loss. So you're showing a loss, but you had $150,000 in income, kind of like what Gary talked about earlier, kind of the benefits of how this can actually work. So it really is an offset. The other thing which people talk about and they get kind of concerned about is recapture rate and the recapture calculation. What's this do to me? How's this impact? Oh, the recapture is going to kill me if I sell it in 4 years or 3 years or 5 years. And we have clients that do them regardless, and they're opportunistic. They may sell early, but there's always some level of recapture. Some won't do it until they're going to have it 5 to 10 years, which that's kind of our benchmark is a 5-year hold period. Kind of makes sense. Well, let's talk about how depreciation recapture works. So that same $2 million building example, the owner depreciates $800,000 worth of building, and we've done a lot of depreciation. You've got a good depreciation. So for tax purposes, the basis now, because you're depreciating it, it reduces your basis value to 1.2 million. That 800,000 is a subtracted, so your basis goes from 2 million to 1.2 million. So essentially, there you go, 2 million less 800,000 in depreciation. So if you sell the building for 2.3 million, that's now a $1.1 million gain over the taxable basis. All right, because your taxable basis is 1.2, you sold it for 2.3. However, the 800,000, which is from the depreciation, the deductions, is going to be an ordinary income, depending on which ordinary income rate is, or if you've got a spouse that's a real estate professional, that's one thing. So that's going to be ordinary income rate. And then the 300,000, because it's paid 200 or 2 million, sold for 2.3 million, that's going to be your capital gain. So that's kind of how we like to simplify how the recapture rate works. You've got to look at your situation. How's it going to play out? But in essence, that kind of simplifies the process. Anything you want to add there, Steve, I left out?
Yeah, well, the only thing I would add is that 800,000 that you're talking about for recapture, if you don't do the cost segregation study, you're going to pay ordinary tax rate on those dollars anyway because you didn't accelerate them, you left them in long life. So really the break-even point or the break point that I always look at is all you have to do is cover the cost of the cost segregation study, and once you hit that, then it's like in effect, like you said, Bill, it's an interest-free loan from the government. So once you once you hit the break-even point, a few $1,000 for the cost segregation study, everything else it's an interest-free loan from the government, and you're going to pay ordinary tax rate whether you do cost seg study or whether you keep it at 27.5.
That's right. Great point. Because a lot of people will shy away because they think recapture rate, and usually you deal with it in the back end of the transaction, the sale. But yes, it's not as punitive as it might appear to be.
That's correct.
So Steve, I have a question for you then, Steve, because we're kind of dealing with this on our property in Tucson right now, where we might be looking at an early exit. So we're considering not doing the bonus depreciation or the cost segregation because of that. At what point, does it make sense? And you said when you cover the cost of it, but is it usually 2, 3, 4 years where it starts to make sense? I mean, what if we exit the property in 18 months?
Yeah, that's a great question, and it's a question that we get quite often, and it comes down to the motivation of the taxpayer themselves and what the strategy is. Typically probably the guideline is 1 to 2 years. Technically, once you cover the cost of the study, then everything else you're doing is again kind of an interest-free loan. But I would think probably that 1 to 2 years is probably a good guideline, but it really is up to the motivation of the taxpayer themselves, because a lot of times in the early years, that income really is valuable to them, to have that additional cash available, even if you have to pay it back at ordinary rates. So it really is kind of up to the strategy and the motivation of the individual taxpayer. But you're right, that 1 to 2 to 3 years is probably a good guideline.
You know, one thing that Kyle brought up before is on that part is like a 1.65 and then nearly $2 million invested with improvements in the property. He's got a lot of, it's just passive investors, right? It's a syndication. So he's passing that through. And most of these folks are W-2 wage earners. They may be 25, 27%. They're good earners, but they're not, 37%. What's the impact there because of that pass through? And I think that might be what he's getting at a little bit.
Yeah, and that's correct. That those dollars will pass through to those individual holders. So again, it's kind of up to the motivation of the individuals. But once it passes through, they can use those depreciation deductions, and then they would have to pay the ordinary rate, at the time of the sale.
Right. It also looks at like the structure. I was talking to one of the CPAs about how it works and how you structure it and how it passes through in a different ways. And that's really, Kyle, some of the things that your CPA can really help you with. But those are great questions in your scenario. But as Steve said, it really depends on the needs of you and your investors. So, all right, recapture. The last thing I've got, how to select a cost segregation firm. Some of these slides you see jumped around, and sorry about that. I think they converted from PowerPoint to Google. But, there's a lot of people out there that do it. There's a lot of people who do cost segregation. We haven't talked a lot about what we do. I've got one slide to kind of do a little stump preaching on ELB, but essentially a lot of folks are doing it. Some are just using off-the-shelf software. Some are doing different models. But what's important is, do they use their own staff to do their inspections and their engineering, or do they outsource? A lot of firms will send out picture takers. They'll, do some engineering in-house. They might do some stuff offshoring. There's a lot of different ways people are doing this. Estimators and appraisers and photographers to perform the inspection. With our firm, the people that do the engineering do the inspection, and they're engineers. Do they get asset management detail? One of the things to ask is, a lot of people, they might provide the detail, a high level detail for the short life property, but the 27.5 year, they don't give you a lot of detail there. They kind of bundle stuff in there with their modeling or sampling methodology. And that's where, like in Kyle's property, there's a lot of improvements to be had. Some are going to be short life components, and some are going to be, maybe you've got to replace the roof, or if you don't have details on what those cost, you're going to lose out on disposition and abandonment. And so that's what's really important, is to have a complete asset detail and a thorough detail. And that's where a lot will tend to fall short. And of course, if, like Kyle's project, somewhere to do that, we would include the disposition and abandonment. He bought it for 1.6, put 300,000 in it. When we go out there, we're going to find out what he did to it. We're going to include the expense, which is better than depreciation, of that $1.65 million investment. He's made a lot of changes, ripped out doors, done a bunch of stuff. Then we have all that disposition and abandonment included. And then we short life all those improvements, new flooring, new doors, not the doors, but all the other components, electrical and upgrades in the apartments. So those are the things that you've got to look at, the core of the engineering and the expertise that the firm is going to use. Is there IRS
in all 50 states, correct?
All 50 states, yep, all 50 states. We've been doing it. We like to get the projects in Hawaii and Alaska. When one of us gets those, and the engineers are just loving us because they have to fight over who takes the trip. So, of course, you also want IRS audit protection. Do they give IRS audit? We provide complete audit protection forever at no cost. Some companies, they give you the working papers, they give you 2 hours, they start charging you by the hour. When you do a detailed asset report like we do, our study's bulletproof. We just answer a question. Audit protection is easy, but we don't charge extra, and we do it for as long as for life. And what information do you need? Every receipt. I've talked to people who go, "Oh, we did cost seg. It was such a pain in the neck. It's like I did everything." For us, Just give us the core data. We do the heavy lifting. And it's not your responsibility. It's what we do. We have to have somebody get us in the riser rooms, electrical rooms, all those kind of things when we inspect. But other than that, just give us the core cost data and we take it from there. Project management, customer service, how's it done? Do they, is it done on time? What's their reputation for that? Delivering work on time when it's committed to is very important. A lot of people miss on that. Having customer service and a project team to kind of manage that project for you is very important. And then, of course, always look at an example of their work. Whenever you look at somebody, if they show a proposal, if I show them a proposal, I always show them an example of what we do and how we do it and try to point out the differences. So those are things to ask a cost seg firm. Again, there's a lot of people out there doing it, and a lot of people do a pretty good job. We're pretty thorough in what we do. We've been doing it since 2002. One of our pioneers, Eric Ernst, the E of ELB, he's been around since the beginning in the mid 80s when the tax law changed. Arthur Anderson, I think, Anderson Consulting hired him out of Georgia Tech as an electrical engineer. So he's kind of one of the gurus of really the MEP systems, mechanical, electrical, and plumbing. That's where ELB shines above most others, is just our depth of going into those things. But of course, everybody's got, engineers, accountants, and construction experts, as do we. That's very important, is having that expertise, having the, software to do those. We use a proprietary methodology, our own system. We've looked at the other ones and they just don't deliver what we want. And you got to stand behind them. So we think that some people out there cherry pick and leave your money on the table. But one of the things we do is that complete asset management detail. When you get a report from us at the end, you get all the detail on the 27.5 year and the short life, and then we deliver it to you or your CPA in an Excel file. So again, they can track for future abandonment and disposition, which is very valuable to you. There's a lot of value to that. We've done well over 14,000 studies, perfect record to IRS. We use our own staff to complete the engineering inspections. We never outsource. And our customer service, we want to really focus being on best in class. Do the heavy lifting. We provide accurate and timely completion of studies. So that's really, the quick advertisement on ELB. And see, anything you want to add to that? And I think we're going to have the last slide to wrap up and talk about next month's event.
Yeah, I think you covered everything pretty well, Bill. I would mention that the majority of the cost segregation studies that we tend to see from companies that are doing them are called residual studies. And basically those are ones where they go out and do exactly what you said. They will cherry pick the decorative lighting, the vinyl floor covering, the carpeting, and then everything else they'll lump into a 27.5 year category. So you don't get that detail on that 27.5 year. You only get what they've cherry picked. Whereas a true engineering based study where we have engineers that go out, they're looking at all of the components of the building, every component, regardless of what the life is, putting a value on those components, and then segregating them out into 5 year, 7 year, 15 year, 39 or 27.5 year. And so you really get a very balanced study. You're putting equal weight on the 27.5 year, the long life, as well as the short life. And that's number one, why you get the highest benefit from the completely engineering based study, as well as very, very thorough documentation should it ever go under audit. And that's really why we've never had a problem with an audit, is because we do provide equal weight to the 27.5 and also the short life.
Right, great point. I just saw the question popped up. This question box popped up, and Gary's been monitoring that, but I did see this. So someone asked, Chris asked, I may have missed it, but why would someone not want to use this approach as opposed to straight line? Why would someone not want to use this approach where it's a straight line? So I can't think of a reason. Of course, we sell cost segregation studies, but why would they not want to do it? When would not be the case? Steve, can you think of something where, an example where you just say, you know what, let's just use straight line where you're not making money, you don't have a profit. You don't need that extra deduction. I mean, really, if you don't need the deductions, it's not going to help you. I mean, you can kind of clarify better and say it better than I can.
Yeah, I think just a very, briefly on a kind of a 30,000 foot look, the reasons why someone may not want to do a study is, number one, if they're not going to hold that property long enough to really recover the cost of the study and get benefit out of that accelerated cash. So people that are flipping properties very quickly probably wouldn't benefit from it. Also, if you can't use all of the deductions, we have had people that go ahead and do the study, but they may slow down the deductions and not use bonus depreciation and some of the things that you talked about, Bill. So there's different accounting methods that you can use to still get the asset definition out of a cost segregation study, but not use all that depreciation if you don't need it. But the only one that I can really think of that where you probably wouldn't want to do it is if you're just flipping properties very quickly.
Yeah, if you're buying them, turn them around, and within 6 to 9 months, less than a year, kind of flipping
Right.
family homes, that just doesn't make sense.
Right.
Now, I've heard some people that say, well, we don't really need that much. There's not enough income to throw it off because it's not throwing off that much income. What they do is they want the asset detail because they have a value improvement plan because they want to sell it for more in 3 to 5 years. So by getting that asset detail and by tearing out doors and replacing doors or windows or flooring or a roof or parking or whatever, then those expenses are very valuable, and that can offset all the income. And depreciation may not be the goal there. And sometimes we just do an asset management report for people. They don't really care about the depreciation. They're looking for the asset detail because of their strategy with the property.
Bill, I might add to that also it becomes kind of if you haven't done a lot of improvements after you've done the cost segregation study, if you're pretty much selling it as it was when we looked at it, it also kind of becomes a kind of a value-added sales tool because you can pass that cost segregation along to a new buyer. And for a minimal amount, we can update that study with a new entity name, et cetera, and just pass that same study along to the new owner.
That's right. We've got to go back and look at the new numbers because they're going to sell it for a profit. So we've got all these spreadsheets. We got to recalculate everything, but essentially the components of that property are still the same.
That's
and if
correct.
there have been minor changes, then we can go and look at, okay, what did you do? Okay, we can accommodate for that. So yeah, we have a lot of people that say, hey, let's take care of that. So I think I don't see any other questions.
Yeah, there's 2 more questions, and Bruce, I'll answer your second question first. He asked, what line item or area would you put the cost seg study on your model? And that's a question for Gary and I. We actually have that broken out into a separate line item as itself. So it would show as just the cost segregation study on what we got an estimate for that cost. His second question, which I know is a tough one to be answered, Bill, but he says, let's say on a 30-unit building, what would be a rough idea of the cost of a cost segregation study?
That's a good question, and it's kind of hard to answer because we need to look at the building. So what ELB does, you can say 30 units, and it's not really by units or by price, but one of the things in doing a study, in that 30 unit, you might have 3 floor plans, a 1 bedroom and 2 different 2 bedrooms, maybe. So we look at that. Once we've done the 1 bedroom and then the 2 bedrooms, 1 of each floor plan, then the rest is easy, but we've got to engineer that. We've got to go and reverse engineer. We've got to measure the property, got to count everything. So, typically studies are between $5,000 and $10,000 on a smaller property like that. Again, we look at the details and the amenities. If it's a 30 unit, but an A-class property is different than a 30 unit and a C-class property. So, it's hard to say, but when we work with a client, we say, give me your property address, give me your core, what you paid for it. We research the property. We spend 30 minutes to an hour or more, depending on the property, researching it, and then coming back with a fee, a flat fee. I mean, that's the fee no matter what it costs us. And then a range, conservative and optimistic, until we don't know what we're going to find until we get there. So that's one of the things that we look at. So I think another Q&A popped up.
The other thing, Bill, that I would add is a lot of times when I'm working with clients is we look very closely at that return on investment. And on a property like that, the ROI is probably going to be fairly significant. I mean, you're probably at least in the 20 to 30 to 1 range, which is a very significant return on investment. And that's what I tend to focus on more than the hard dollars, because you're right, that does tend to vary. One additional point is you bring up a good point, Bill, is that our fee is based on our time that we have into that project. It's not based on any kind of return, or we don't tie it to anything, because the IRS looks closely at how you're pricing these out. So we give you a fixed dollar amount right up front, so you know exactly what the dollars are going to be, and you know what that return on investment is going to be.
I've got another thing, Bruce. asked, I'm not sure about this, he asked about a cost seg on a fourplex and with the value add. And one thing we didn't talk about, so a cost seg study is, you know, engineering, going out there, a lot of folks, and sometimes it could be a lot of costs. A lot of the things like on bigger pockets, oh, they cost so much, it's crazy, you shouldn't do it. Not necessarily, because you look at the ROI. But on a property like this, a fourplex or a single family, we introduced it a little over a year ago, a thing called DIY cost seg, which is a modeling system, which is like what a lot of our competitors do. We'll model those buildings. You can key in the core data and get your answer back in minutes on your property. And it's less than $500 for a single family up to 4 units. So it can be a single family, a duplex, triplex, or a quad, same price, under $1 million. You can get that value for under $500. And we'll provide audit protection, because there's an insurance policy you buy. If there's ever an audit, because a single page result won't give you audit protection, IRS, we'll go out and send our engineers out to your property and do everything. Now, we are going to err on the conservative side, but you're still going to get lots of value, and it's a low cost alternative. We also do it for commercial properties, apartments that are under $1 million, you know, 5 to whatever units, and dentist offices and warehouses, and it just anything under $1 million. And a commercial property is going to be basically $1,200 to do that. So that's one thing to say. There are, and other companies have those. There are options out there for a lot of residential 1 to 4s, but we also do it on commercial under $1 million. So I wanted to add that to Bruce's question.
So why don't we go to the next slide and share your contact information, because I'm sure a lot of people would love to get that.
Yeah, okay, yeah, I should have had that up already. I'm sorry about that. So yeah, Bill Smith, it's spelled just like it sounds, as you can see it. I actually got 4 names, and you can reach me at bill@elbcostseg.com. If you think Steve is smarter and you want to reach out to Steve, it'd be steve@elbcostseg.com. And we work together as a team. In my office, I office in Raleigh, North Carolina, 919-858-6140 is my direct office line, and my mobile line, 480-747-5547. That's an Arizona number for all you guys that know Arizona, love Arizona. I was there for 12 years, miss it. Been out here for 2.5, but returned to the East Coast. So there we go. I think there's one more slide that you have for your next month.
Yeah. The amazing benefits of cost segregation, and I'm sure everyone that tuned in as well. So thank you guys for your expertise. If you want to get in touch with Kyle or myself, our information is there. Please reach out to us on social media. We put out a lot of free content. We'll be back next month for our multifamily investing, passive investing 101. So please join us, and we look forward to connecting with you guys in the future. Thanks.
All right. Thank you.
Thank you.
Bye.